Hello again, everyone. This is Joe Henches with Beyond the Chart. And in this options trade review, we're going to take a look at an options trade on Electronic Arts that we do with our insider members inside the membership. So stay tuned. So on June 22nd, and when was June 22nd? Let's look at it right here. Is June 22nd, the morning of June 22nd. What I'd seen was I saw this moving average cross. This is a 10 EMA. This is a 21 simple. These down here are longer term, 55 EMA and 89 EMA, okay, exponential. So the 10 and the 21, we got this cross to the downside. And so what I was really suspicious of was this going to roll back over, and that this initial move right here, or not initial, this secondary move, we had this initial move right here, that this pullback was a counter trend, and we're going to resume in the direction of the moving average cross. That's what I was thinking was going to happen. So on the morning of the 22nd, I said, let's go ahead and get into this, but I want to get in at an entry below the low, which was yesterday's low. The low was 111.83. And I wanted to give it some room, and so I said sell at 111.17. And that was the entry point I was looking at. We were looking at July 110, so we were going to be slightly out of the money in here, just a little bit out of the money. The stop was going to be a consecutive close above the 10 exponential moving average. The initial target was going to be 104.39. Now, as you see, we never really got to that target, and I'll talk about that in a minute. So on the 23rd, which is right here, is when we actually got an entry into hitting 111.17. So we didn't get it that day. We never got quite down to 111.17. We did get that entry here on the 23rd. And so now we're in. And we were in with the July 110 puts. Got them at $228. That's $228 per contract, or $2.28 is the way they price it out in options. If you're not familiar with options, it's because every option contract is for 100 shares. Okay, so now we're in, and after being in this for a while, we could see we started to slow down. We were stalling out down here. I'd been in for 1, 2, 3, 4, 5, 6, 7, 8. That was the 5th. And finally on the 7th, back over in here in the morning, I said, look, we're exiting this position. We've been in for at least 8 trading days. If we get a close above the high 2 days ago, we're going to be out of here. Okay, we're going to exit the trade. Well, that's exactly what happened on the 7th. We see we had 8 days. It never hit our target down here. It kind of got very close, but then stalled out. And then it closed here above the high 2 days ago, which was 107.31. It closed at 107.45, and we exited, sold all of them. Made $132 a contract. And where did we actually exit? So let's say we exited at the close, which I believe we did, 107.45. So yeah, we had 110 puts. So we were in the money, and we were slightly out of the money when we got them. So you see we got a nice appreciation on it. 58% profit on the trade. Not bad. And again, we were in for 2, 4, 6, 8 on the 10th day. So that was that trade idea. Worked out very well. Now I'm going to tell you a couple of things about this. I have started to change where I'm not using the 21 anymore. Now, for this particular setup, I did use it. I just find that the added value, that it just seems to be more confusing than anything overall. Now, even if we wouldn't have had that, I would have been looking for an entry here. Why is that? Because the RSI was below 50 right here. We got to close below the 10. We had significant bearish divergence in here. Okay, what am I talking about? The RSI showed bearish divergence between these 2 points, and it was showing up on the demand index. It was showing up on DI plus of the directional movement. We had the directional movement cross where the red was above the blue. The selling pressure was kicking in. So all of the indicators were aligning, and we got to close back below the 10. So even without ignoring a 21 simple moving average, this would have been an entry play at least getting in right in here at the low. Maybe, you know, might have been a little bit worse, but still would have been very, very close for the entry. Now, the fact that we got out, that's fine. We had a stop that we used in here. But the mistake that I made on this is not getting back in right in here. After we got the closes back above the 10, the RSI right here was less than 50, so it wasn't perfectly aligned yet. The demand index was still negative, and DI minus was greater than DI plus. So the indicators weren't lining up yet. But over in here, they started to. They actually started to right in here. So right in this area would have been a perfect entry to get back in, especially after this little pivot was made, because you could draw a little trend line right here. And once the moving averages align, you get this little break, especially at the close right here, and you would have had a really nice little swing move to the upside and gotten outside the Keltner channels. And if you waited and exited on the first close back inside the Keltner channels, you would have got out the close right here. So this is just an example of a really nice trade that I missed, okay, that you could have had. And, you know, I'm not going to catch them all, but I am going to start leaning very strongly to taking the trends with the longer term moving average. Okay, that puts the odds in your favor. Now, when you do get significant bearish divergences like we got back over in here, there's nothing wrong with taking, you know, when the indicators line up and you get a close back below the 10, there's nothing wrong with taking that trade also, because you've got all of the reasons that you've lined up for taking that trade. You just have to be ready to pull that trigger and exit fairly quickly like we did. Just because, you know, you are going against the grain, you never really know what you're going to get. You know, the other thing I saw when I looked at this over here, there was this potential head and shoulders. I mean, let's ignore all of this right now because you didn't really see it. Okay, so, you know, as you see this lined up, you could have sat back and said, well, you know, we got a potential little top that's forming in here. Okay, so along with the major divergences I was getting, I was thinking, well, you know, we might be getting ready to break down. Okay, well, you know, the breakdown never happened. They resumed the trend to the upside. So there's, you know, you're just constantly looking for scenarios, but then you just have to play out your plan. And, you know, if you start to feel like things aren't quite, you know, aren't getting exactly to where you thought they were going to get in terms of the target, you know, you got to just be able to trail your stop and exit, you know, like we talked about and like we did right here on July 7th. All right, that's it for this video. I hope you found that helpful. You know, another great example of the power of an option trade. Again, you know, you don't go way out of the monies on these options, and you got to give yourself some time, okay? So that's the trick with using the options. All right, that's it for this one. If you thought the video was helpful, please hit the like button. If you're not a subscriber, hit that little logo in the lower right-hand part of the screen. It's a little transparent little thing, and subscribe to the YouTube channel. And that's it for this video. Everyone have a great day.